Making your first investments can be exciting or scary depending on your comfort with the market. The thought of taking your money and buying something that you can't see in the hopes that eventually someone will buy it for more almost seems like a scheme. So it's easy to understand why so many people don't invest their money. We hear horror stories of people losing their life savings or everything that they own. But if you know some of the tricks going on, things are a bit less intimidating. If you're new to investing, let's talk about some of the things that could happen in the stock market, and let's get to it. What's up YouTube, James with Thursday Media here, and in this video we're going to cover 7 things that I wish I knew as an early investor. Now this is a video for beginners, but if you're a veteran and you have more to add, leave that down in the comments below. Recent polling has shown that on average about 55% of Americans hold stock, whether it be in cash, margin, or retirement accounts. While this is more than half the country, what is often being left out is how many of these people are consistently investing, and that number is probably much smaller. And that's probably because for many, after that first big loss, they lose motivation and they give up. So here are some things to watch for when you begin your journey in the investment world. Before opening any brokerage account, the first thing that you really need to watch for is hitting the like button so that YouTube knows that we're still in the game. Let's begin with the price of a stock. Oftentimes, price doesn't matter in the way that we think that it does. Price is one of the factors we get attached to because we relate it to when we're shopping, and we get wrapped up in numbers of shares instead of the value of our purchase. Let's assume that you have $100 to invest. You could buy 20 shares at $5 of a car company that you heard about on Reddit. You could also use the same $100 to buy 1 share of a tech company that you saw on the news. In both cases, you invested $100. What's not important is the number of shares that you own in this instance, but the value of your purchase and the performance of those companies. Lower price doesn't mean greater value or vice versa, because the price of a stock is based on a ton of factors, including the number of individual shares that are out. What's important is paying attention to the percent gain or loss on that $100 that you put in. Second, don't start in penny stocks. The fastest way to get the wrong impression about how the stock market works is to purchase the most volatile stocks. Penny stocks are companies with very small market caps and are traditionally in the process of getting established. They tend to be higher risk, so it's possible for your money to 2x very quickly, or watch it bleed to nothing. Focus your early investments into stable companies, and that way you get used to seeing that money rise and fall before playing the penny stock game, which requires a lot more attention. Next, stock splits can be tricky. A stock split is where a single share is divided, giving you more shares. The same can be done in reverse, where many shares can be reduced to 1. While in principle, a split or reverse split doesn't impact your total value, the intention behind the split will. A stock split is usually an exciting event that's done to make the stock more appealing to buy. When Apple and Tesla decided to split their stocks last year, the companies rallied on the news and the stock price went up ahead of the recording date. On the other hand, a reverse split is used when the stock price seems too low and is typically seen as a negative event. Reverse splits will often trigger negative sentiment, and a sell-off will follow. You also know that you're invested in a rough company if they perform a reverse split and then offer new shares shortly after. On the topic of selling shares, this is referred to as dilution, and this increases the number of shares. In struggling companies, this will typically be seen as a negative thing, and the value of what you own will likely go down. But sometimes dilution is done to expand or improve an already successful business, and those extra shares will come with expansions, acquisitions, or new products that will add value. So understanding the intention behind selling those new shares will help you determine if dilution is going to have a positive or negative long-term impact. While a day trader will focus on short-term entry and exit timing for long-term investments is a little less exciting. If you plan on holding a share for a long time, waiting for it to dip a little to buy in doesn't really matter if you feel like the investment is a good value. The key thing is to find a good opportunity or value rather than waiting for a market correction that may never come within the time frame that you want to buy. If you really like a company and believe in their business, then the entry shouldn't really matter if you plan on holding that share for 10 or more years. In fact, most studies find that staying invested in the market usually yields better results. And that's simply because while you do catch all of the bad times, you catch all of the good ones. And there are usually more good times than bad in the stock market. Still, let's say that you do buy a stock at a major peak. You would probably see a correction shortly thereafter. Go into the market with the expectation that everything that you buy may be subject to a correction. If you're buying good stocks, the first correction you see should motivate you to get in and buy more before it turns around. Corrections happen, and sadly, many panic and sell during this period. But corrections are great times to buy and add to your holdings. So you have to think about it a bit in reverse and look at a stock correction as an opportunity to buy instead of a signal to sell. Finally, stocks aren't Pokemon. You can't catch them all. You will hear about some stocks going up 2x, 3x, or higher all the time and wonder why you didn't get in, or worse, you buy in late and wind up buying it overvalued. The fact is, we can only research and know so much, so we're gonna miss opportunities that others found. But it happens to everyone, so don't let these events influence you to buy something that you know nothing about. More often than not, new investors put money into a stock just because it's going up, and that's as far as they know. Have a plan with every investment you make, know when you want to sell, and don't be upset if it keeps going up more. It's a matter of sticking to your plan and knowing your risk tolerance. As a bonus, I'll go ahead and mention one thing that you can do if a company's stock is a bit too expensive to buy. Several brokers offer fractional share buying, so you can invest a dollar amount into some of your favorite companies that may be a tad too pricey. Also, remember that the stock market is not a casino, though it is possible to gamble by buying things without doing any research. Doing your homework and understanding the companies behind the investments that you make will give you the peace of mind to continue making good decisions and invest consistently. But as always, I am not a financial advisor. I'm just a regular guy with a regular job, sharing some flashbacks of a time when I wanted to be the very best like no one ever was. So do your own research and make sure that you make financial decisions with a strategy that you're comfortable with. If you're interested in beginning your investing journey, I'll leave some links down in the description below that'll help get you started. Some of these are even offering free stocks when you sign up and make your first deposit. If you found this video helpful and you want more like it, make sure that you subscribe to the channel. I post every Thursday and Sunday, unless I throw in a bonus. Good luck getting your feet wet, take your time finding those investments, and thanks so much for being here, and I'll see you in the next one.